This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, even if the Fed is proving to be stubborn, we'll pivot from focusing on monetary policy to look at the results from a blue-chip consumer name and reflect on what that means for the underlying economy. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and I'm only going to spend a few breaths right now on the Fed, just pointing out that this past week, we had a stronger than expected existing home sales number. We had unemployment data for the period that was also better than expectations. But also, we got the minutes from the last Fed meeting, and as you might expect from such data, and what you may very well already know, is that the Fed is not in a rush to cut interest rates right now. And the consensus was firmly in the camp of being wary of acting too soon rather than too late. But the people on the Fed also added that in their March meeting, they're going to be re-examining quantitative tightening, which I addressed on this podcast not too long ago. And that might be prudent, as that might help long-term interest rates, things like mortgages. And they also had a pretty crummy Treasury auction last week, which is quintessentially important to their normal operations. So we'll see if they show some love over there on the quantitative side in a few weeks. But to try and not make every podcast about the Fed policy, today I'm going to take a bit of a departure, as I'm going to talk about a stock, one that I do not own, and one we don't own in our managed portfolio for our clients. But I wanted to take some time and look at Walmart, not so much as an investment idea here, but as a canary in the coal mine for the U.S. economy and the U.S. consumer. Now, Walmart can be thought of as in a few different ways. It can be a company that people gravitate towards too because they think it's resilient if there was a soft economy, because it can attract dollars from more expensive outlets and more expensive ways of consumers spending their discretionary dollars because Walmart has all these discounts. But still, at the end of the day, it is a retailer, and for the most part, it's a grocer. Actually, about 60% of their total sales now are groceries, and those groceries account for about 1/4 of total grocery sales now in the U.S. Now, personally, I think of Walmart, and I am definitely not a great proxy for the average American consumer. I really don't wander into retail shops that much at all. But I think of a Walmart as a place that I might go to if I need to buy a cheap cooler for a day out in the sun, I guess, or maybe I needed a folding chair if I needed one. But obviously, they're not only a tremendous grocery outlet, but they're a big clothing retailer. They're a sporting goods store, a one-stop solution for most of what the typical family may need. So I do want to look at what they experienced in the fourth quarter of last year and what that is saying as it acts as a proxy for what we're seeing out there in the overall economy. Now, to some degree, you could classify this as a great business, right? I've already made the case on how it's this big, dominant retailer. It's the biggest grocer. Obviously, Amazon has something to say about that, and we do own Amazon. I also own that stock myself, but I think Simon went over Amazon a bit last week. But either way, while direct-to-consumer sales, that DTC part, has been an important area of growth for Walmart, and if I would spend more breath on that, I think, if we were talking about an investment thesis there. But you can go to the store now and, either online or in person, you go there and you could order a 6-pack of tube socks. But the point is, they are the biggest name still in bricks and mortar stores, which is part of the challenge. But also a challenge is, how can they possibly grow their sales and grow their earnings at this point after what they've already turned themselves into? They said earlier this year, in January, they expect to open 150 more Walmart stores this year. Sounds like a lot, but they actually already own or have over 10,000 stores, which is actually a number that's well off its peak that it made about a decade ago. There were well over 11,000 stores. So the company has to grow from same-store sales and by maintaining and growing margins which is hard when an enormous piece of the business is groceries, which sell at almost zero margin. So according to Value Line, Walmart's net profit margin now is below 3%. And it seems to have been dancing on either side of that 3% number for the last decade or so. Has a dividend, but it's kind of unremarkable. It's about 1.4% today. And Value Line expects them to grow that dividend by about 5% a year. Again, nice, if unremarkable. So, it's just not blowing my hair back. In fact, in the January edition of Value Line, they say that they see it as, quote, a good option for those investors that are still looking for big box retail exposure in this uncertain macroeconomic environment, end quote. But I really don't get that. I don't know who's looking out there searching for a big box retail exposure right now. And, not buying a stock at all is always an option. But I guess there's the case that Walmart decouples from the market and goes up when everything else pulls back. I don't know. I don't see it. But again, this is supposed to be a story about the consumer, not about the stock. So let's look at the results and what that says about the American consumer right now. In a February 20th article in the Financial Times, they said that Walmart didn't see prices decline as much as anticipated during the fourth quarter. Well, this harkens right back to the reality that we're all now facing, and back to what we were saying on this show back in December, that I just wouldn't bank on those 8 interest rate cuts so fast. The pressure to cut from the economic data is very, very little right now, except for the constant whining from Wall Street who wants interest rate cuts. And, we get the jobs reports are still better than expected. Inflation is not cooling as much as had been thought, unless maybe this January inflation numbers, maybe those were head fakes. And that is possible. And that's a big part of the narrative now, that January was a bit of a blip. But these Walmart stories were actually looking for declining prices, not just moderating inflation. They want to see prices declining, and you're not likely to see that in the price of the proverbial cheaper cooler or the folding chair. But you might start seeing that in grocery prices, if not in that pack of tube socks. In fact, in their quarterly conference call following the earnings release, their CEO said that, quote, our general merchandise prices, i.e. tube socks and coolers, are lower than a year ago. So I guess the cooler is a bit cheaper, and even 2 years ago in some categories, which means our consumers are finding value in areas like apparel. Going on, though, in food, prices are lower than a year ago in places like eggs, apples, and deli snacks, but they are higher in other places like asparagus and blackberries, end quote. So he gets pretty deep into details there with a very specific readout with the bottom line that inflation is moderating overall for their consumers, but still sticky and stubborn in areas without a measurable threat of the Fed waiting too long. Meaning the Fed doesn't have to act too soon. That's what this is saying. Inflation is improving, but with the reasons that the Fed would want to cut, meaning the economy is slowing too fast and unemployment numbers are going higher, they can afford to wait. And this goes back to why we do, despite so many cynical responses, why we do collectively look at core inflation data. Because the price of energy and food can bop around pretty good at times, both to artificial upsides and then at times maybe this year to deflationary or declining price levels, while the rest of the economy is still pricing in prices really just kind of leveling off. The big reason you strip them out is not just because they're too volatile, but also they lead to double counting. You get higher food and energy costs. That also leads to higher costs elsewhere, and it magnifies the effects when tracking these things. So for Walmart, we might hope to see lower grocery prices and improving margins, but I wouldn't expect to see that happening maybe at restaurants where they're likely to keep prices steady and enjoy the restaurant owner enjoying the difference in the form of therefore higher margins. So for this past quarter, though, Walmart did cite moderating inflation in their total costs, running at about 1% on their sales top line. But more importantly, the headwind on the higher prices on consumers' wallets is in Walmart's case affecting their product mix, and that it's a greater portion now of what their total sales are going to groceries. And that's a good read on what middle America is facing right now, and probably expected to persist. What this means is that they're seeing wages overall increase in the last 6 months higher than the rate of inflation, but that just started recently. And they have to pay more of their overall paychecks on groceries, even though they may experience less inflation overall. More of that money is going to groceries and therefore has left to spend on the cheap coolers and the tube socks. And therefore, the zero margin groceries are a greater portion of the whole from Walmart and beyond Walmart. The American consumer is largely employed. Their paychecks have gone up over the past year more than the core rate of inflation, but still they're having to devote more to basics and have less for discretionary spending, and the people at Walmart expect that to continue into this year. For Walmart, while some same-store sales growth was strong to end last year, up 4% overall for 2023, according to Goldman Sachs' analysis for the quarter, it was powered by growth in groceries, which were up mid-single digits, while this general merchandise category, the more discretionary and much higher margin items that they sell, they were actually down low single digits versus the same time period, the end 2022 versus 2023, which, of course, that is the most important quarter for discretionary spending because that includes Christmas. And recall, I just said that the prices in general merchandise were actually lower than a year and 2 years ago. So it's not that the consumers can't tolerate the prices in that category, but again, their dollars are just getting sopped up by the higher costs elsewhere, like those expensive blackberries, I guess. Okay, I'm going to take a quick break here, but I'll be back in a moment to take a broader view of the market here. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Don't be forced to sell stocks in a bear market. Now is the time to review your financial plan and determine how much liquidity you truly need. I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know about them. To learn more about how to manage your cash flow and to become a better informed, wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Despite the anticipation for a pullback coming into this new year, by many, after what we saw as kind of euphoric pricing of anticipated interest rate cuts, as it reflected in the stock prices over the last couple of months of last year, now it looks like the market has largely shrugged it off at this point. We're not as anxious, or we don't have the same expectations for those cuts, but the broader indexes are higher. And that's reflected in what we have now as a 4% gain so far for the Dow and about a 7% gain for the S&P 500. And the narrative and pricing in the futures is not for 8 interest rate cuts now, starting in March, but the pricing in the markets, where these things are actually gambled upon, I guess, is now pricing in more like 4 cuts this year, starting later this year. To some degree, the markets are just being patient, albeit still anticipating and pricing in cuts that otherwise seem inevitable. We saw a fund manager from Brevin Howard at that conference I was talking about a couple of weeks. I wrote down the quote because they said, quote, investors are willing to pay higher multiples because they believe rates will be lower and price as if, unwilling to accept higher for longer and model for that, end quote. They're unwilling to accept that the Fed is going to do what the Fed keeps continuously saying they're going to do. And since the Fed has kept rates more or less at emergency low numbers for 16 years, more or less now, and beyond that, interest rates have been at historically below average interest rates for about 25 years now. Maybe we're just facing a world where not enough investors, not enough people on Wall Street, maybe not enough of them have experienced lasting periods of using that discount interest rate in their pricing model that are sustained at these levels. They've just become too accustomed to seeing 2% lower than they are today as normal, even though if you look at much larger data sets, it's anything but. But as that may, the most dramatic rallies in the market we've seen recently, specifically in certain stocks that have continued to soar to new highs, just as the overall stock market has now continued to reach new highs, it's not been powered by expectations of many interest rate cuts, lower interest rates, which would allow for higher multiples, but instead powered higher by both strong earnings results and, more importantly, guidance for the coming year, for the rest of this year, that in those cases is well above the current estimates currently priced in. Basically, the leaders in the market, those that are doing well, and in most companies that are really taking off, which is a market that is very fragmented. I mean, if you looked at my screen on my desktop, you'd see pretty even mix of stocks that are up for the year versus those that are lower so far for the year. But those that are making these new all-time highs aren't doing so necessarily by climbing higher and higher multiples to earnings, but they're doing so by raising the expectations for what the actual earnings side of the equation will be. Now, a good amount of the 2023 rally was raising that forward multiple on stocks. And I was wary because the market started off in the high teens, multiple to those expectations. The PE was in the high teens and finished at about 20 times what was expected for this 2024 year, based upon an expectation of earnings growth in the low teens for this year. But companies are now guiding in many cases, especially those names that are leading the indices higher. They're guiding for the future such that those earlier estimates may have been and may still very well be too low. As of the information FactSet provided a week ago, so this doesn't yet include some pretty dramatic upside in some big chunks of the S&P over the last week. At that point, a week ago or so, 80% of the S&P at that point had reported their quarterly results, and 75% of them had reported positive upside surprises going into those results. The forward 12-month PE at that point on the S&P 500, now about 21 times 2024's earnings estimates, well above the 5-year average of 19 times and 10-year average of 18 times forward earnings estimates. However, also embedded in FactSet's earnings insight report is that the consensus among Wall Street analysts is that for each quarter this year, they now expect respective year-over-year revenue growth of 3.5, 4.6, 5, and 5.7% coming in the fourth quarter this year. You know, we have an election coming, a lot less clarity about the direction of monetary policy, many debating the future of the economy, global crises, all these problems. But when boiled down to the estimates, the collective brain trust is mapping out accelerating earnings growth, which should also be noted is versus a tougher year-over-year comp on each subsequent quarter. Year-over-year growth for this first quarter is easier than it will be in the relatively stronger fourth quarter of 2023 versus what it will be in 2024. So that ramp up year-over-year in each subsequent quarter is just that much more impressive if it turns out to be accurate, and even more so if it's underestimating what we see. Again, we're only less than 8 weeks into the year, so I need more data to go on. But overall, the number of companies beating estimates and the percentage by which they beat that estimate is below the 5-year average. But the market, most notably here, is rewarding those that do beat the estimate by more than average. So those that struggle are getting punished. But according to FactSet, companies that have reported positive surprises in their earnings have on average risen 1.5% from the 2 days before their earnings report, through the 2 days after they announce it versus a 5-year average of 1%. And this doesn't include seeing some pretty large names going up 15 to 20% after they report, which happened after this current FactSet report I have was available. So I don't know if their data is just using all companies equally or if they're factoring them in a weighted way the way the index does. If that's the case, then that 1.5% will re-rate quite a bit higher because these were some pretty big components that did well. The bottom line is as of February 17th, so a little while ago, the S&P was trading at over 20 times the 2024 consensus earnings estimate. And that's based upon an estimate in that same report of 11% earnings growth this year on 5% revenue growth. Now, there's so much that I think will cause volatility this year, but ultimately, I still think we can be higher. The index can be higher on December 31st than it is today based upon these estimates of revenues and earnings being too low and seeing this market climb on results, not on multiple expansion. Now, if we don't see those estimates continuing to be exceeded overall, but instead maybe the soft landing gets a little bumpy, if we hit one dramatic hiccup too many this summer, things get a little too squirrely going into the election, then it's harder to imagine the broad market much higher than at this current peak. This is still, ultimately, it's a time where fixed income alternatives that you can invest in are paying more than they have probably in about 15 years. You can get a nice interest rate on a money market, just having money liquid in cash, somewhere in the low to mid single digits as far as an interest rate. So it's allocation that you really should focus on most overall. Combat the fear of missing out and take a balanced approach, an allocation approach that is appropriate and keeps you on that path to financial success based upon hopefully a well-constructed plan, rather than believing this party can never end and taking too much exposure to what I wouldn't predict, but what could always end badly. Let's hope not. All right, that's it for me this week. I'm Chase Hinderstein for the Wise Investor Show. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.